Hello, everyone, and welcome to. Oh, let's see. Where's the audio here? Ah, there we go. Hello, everyone, and welcome to another episode of the David Hittle Real Estate Show. And I apologize. I'm trying to get prepared here. Nothing wants to work according to plan. What else is new, right? But we will get set up here and ready to go. I might just have to do it in a different way. And of course, the YouTube visual is not looking when you're in the midst of trying to get something done live. Things always tend to pop up and all tend to cause an issue. But again, we're going to get that bring you today's episode if things stop just popping up here on my screen. All right, so let's see here. I want that, which I guess I should have downloaded the first time, but I didn't. But now I have it. And so, welcome everyone. My name is David Hittle. I'm a realtor with United Real Estate Louisville. And today we are going to be covering together what happened in the real estate market in 2021 and what are the predictions for what is going to happen in 2022. And of course, it's very important to know this information because if you are planning to buy or sell a home, you need to be up to date on what is happening in this real estate market. And I can tell you for today, for just 2022, we're almost done with the first month of 2022. It has already been chaotic. It has already been crazy what is happening in the market already. And we're just a month in. So again, we're going to talk about what happened in 2021, what happened in that year, but we're also going to talk about what is happening in 2022 and the predictions for what is coming down the pike. Again, my name is David Hittle. You can visit my website, shopkentuckyhomes.com. And on that website, you can stay up to date on all this news. I send out a weekly newsletter and I also provide monthly housing market reports for your specific area. You can find out what is happening in your neighborhood just on that website, from that website, shopkentuckyhomes.com. But let's get started with the quote of the month, I guess we could say. This is from Bill McBride, the founder of Calculated Risk. And he says it is possible that rising mortgage rates will slow the housing market, or the Fed might raise rates sooner than expected due to the recent pickup in inflation. But I believe one thing is certain: inventory will tell the tale. So, what he's talking about there is mortgage interest rates. So, this past week, mortgage interest rates finished out at 3.55%. 3.55%. That is the highest rate we have seen in a couple of years now, and it is ticking higher. The previous week ended at 3.56, so we actually saw a slight dip to that 3.55. But from everything I have read, the Federal Reserve, the Fed, as Bill McBride said it, the Fed is planning to raise interest rates in March. So, what that means is we have already seen these rates rise from 2.65, an all time low, to now 3.55, almost a full percentage point higher than the all-time low set back in January of 2001. But again, as he points out here, inventory will tell the tale. So, what does that mean? Well, the inventory structure and the market structure set up the way it is today, we are still in a seller's market. And what that means is that there are more buyers in the market looking for homes than there are sellers in the market selling homes. So that leads to a seller's market. It puts sellers in the driver's seat. It makes sellers more competitive. They have the advantage over buyers. And what is happening now, the bad news for all this, is that listings are at a record low. Here in the Louisville market, there are currently 1,200 homes on the market. In Louisville, only 1,200 homes. Now I was pulling the data up here to give you a update. Are important. But yesterday, of course, it was 1,200 homes on the market in Louisville. And today, as it calculates, we are at 1,188. So about 20 homes sold yesterday. So if we add the Lexington market to this, we have 2,574. The Lexington market by itself is at 1,385. So the actual Lexington housing market has more homes available on the market than Louisville does, which is amazing. And then Northern Kentucky has 521 homes on the market. So all three combined, we're at a nice number of 3,095 homes on the market. So there are 3,905 homes on the market in our immediate market. So Northern Kentucky, Lexington, and Louisville. But still, that is a record low level of homes. Looking at Kentucky, we have a year over year change in inventory of negative 13.2%. So this time last year, there were 13.2% more homes on the market. So the number of homes on the market today is far less than what we had last year. And of course, last year was a record year. The national average for change in inventory year over year is negative 26.8%. That is staggering. That is staggering. That's like there is more than a quarter, more than 25% fewer homes on the market nationwide than today. Looking at the numbers, there is not one state on the map that has a positive year over year listing inventory. The only one that comes close is Oregon at negative 0.07, or well, negative 0.7. They're the closest one to a positive inventory. No state in the nation has more inventory this year than they did last year. Looking at the chart, we last year we saw 4.6 months of inventory nationwide. Today we're stuck at 2.1, more than half, uh, half the half the amount of time for months of inventory. However, with all that being said, we're still in a seller's market because showings are still strong. Buyers are still out there looking for homes, and they're actually out there looking for homes in higher numbers than they were last year. So now, think about this. Nationwide, we have fewer homes on the market, 26% less homes on the market nationwide this year than we did last year. But today, we're seeing higher buyer interest than last year. Amazing, if I do say so myself. So 176 it's an index number. We were at 156 last year. So the index is up 20 points over last year. And of course, last year, booming year. Buyers were everywhere last year. The highest index for last year was 284. We're at a 176 today. So 284 was the highest index recorded last year. And before that, 2020, the highest index was 200. So it is a strong buyers activity, very strong buyers activity out there. And sellers have the opportunity, homeowners have the opportunity to take advantage of that. There's a lot of buyer interest in the market today. Even today, with it being cold and wintry, there is still high buyers' interest out there, and buyers are still looking for their next home. The number of showings, this is a showing index for the last 5 Novembers, because that's the most updated data that they have, shows that showings now are crushing pre-pandemic numbers. So the showing index for November of 2021 was 175.7. 2020 was a 156, and 2019 was a 107. 2018 was a 98, and 2017 was a 103. So we have never seen showing index numbers like this even before the pandemic. Michael Lane, he's the VP and general manager of Showing Time, and Showing Time is the app that realtors use to schedule appointments to show homes. So they have a lot of data. He says that showings traditionally lag during the holiday season. That's true. But the data we are seeing tells us that buyer demand remains strong. The fact that every region has showed a year over year increase indicates that buyers are undeterred, and it speaks to their desire to keep searching for their next home. So what does that mean? That means that home buyers are still in the market, even with a virus, even with a pandemic, even with um, higher home prices, even with higher interest rates, even with supply chain issues, home buyers are still in the market to see homes and to buy homes. And that is important for homeowners to realize and for homeowners to know that getting their home out there and in the market today and beating the competition that almost inevitably comes in the spring, summer, and fall means that your home may sell now, helping the buyer with interest rates, helping you with interest rates when you go to purchase your next home. And all in all, it's better to get it sold while the getting is good. Pending sales are also higher than pre pandemic levels uh, by a little bit. The pending sales index is at 122.4 for 2021, only beat by 125.8 in 2020. So the pending sales were a bit higher in November of 2020, but only slightly lower in November of 2021. However, the biggest thing, there's one major success story, one major reason why somebody should own a home. And that major reason is home equity. When you rent a home from someone else, you are paying rent. You're not paying a mortgage, you're paying rent. So when you pay rent to the landlord, that landlord can then pay their mortgage or pocket the money or whatever. You have no earnings when you pay rent. The landlord does. The landlord is seeing their equity skyrocket, as all homeowners are. They're seeing their equity skyrocket while you are seeing your rent go up. Imagine that. The major reason to own a home in any market is because of home equity. And the 2021 Realtors Conference and Expo was quoted as saying the lack of insight around home equity presents an opportunity for real estate professionals who are always looking for touch points with past clients. Your home equity is a thing of beauty. And here's the numbers. It's from CoreLogic, their quarter three homeowner equity report. Now, think about this. I also published an article last no, didn't publish, but I shared an article on my Facebook page about home equity last week. So this week these numbers are a bit older, but they work. CoreLogic's quarter three homeowner equity report shows that the average home equity gain for U.S. homeowners with mortgages was $57,000 last year in quarter three last year ending. 31.1% was the year over year percentage increase in equity for U.S. homeowners with mortgages. Let me repeat that. Let me put that in layman's terms. Last year, through quarter three, there was a 31.1% year over year increase in home equity. The value of your home minus what you owe on it increased 31.1% last year on average. That is amazing. You cannot get those type of returns in the stock market for sure. And 3.2 trillion, that's with a T, trillion, is the year over year total increase in equity for U.S. homeowners with mortgages. Wow. So this summer, home price growth reached the highest level in more than 45 years, pushing equity gains to another record high. And looking at Kentucky, the average equity gain year over year in Kentucky was $24,000. So the average homeowner with a mortgage gained $24,000 in equity last year. Amazing. Tennessee did better than us, of course. They're having a huge sellers market down there in Tennessee. They saw $53,000 in equity gain year over year. Indiana 37,000, Ohio 27,000. Pretty good if I do say so myself. The highest state with equity gain was amazingly California. California, average equity gain 119,000, but their homes are a lot more expensive than ours. National average 56,700. So Frank Martell, president and CEO of CoreLogic, says that not only have equity gains helped homeowners more seamlessly transition out of forbearance and avoid a distressed sale, but they've also enabled many to continue building their wealth. And that's what it's about. Your equity in your home is part of your net worth. If you want to become a net worth millionaire, then you need to have a lot of home equity. Pay that house off early. Odeta Kushi, the deputy chief economist of First American, says that U.S. homeowners own, now this is a big number. Think about this number. U.S. households own $36.8 trillion. $36.8 trillion in in owner occupied real estate. Wow, that means you actually own the home and you're living in it. $36.8 trillion. There's 11.5 trillion in debt, so that's the amount of mortgages, and the remaining 25 trillion dollars is equity. Wow. Those are big numbers. Big numbers. In inflated adjusted terms, homeowners had an average of $294,000 in equity in quarter three of 2021, which is a historic high. Amazing. That is amazing. So that is what happened in 2021. Amazing stuff, gangbuster stuff. It was a great year in real estate. If you bought or you sold a home in 2021, you got to take advantage of the equity. If you sold your home, you got all that equity. If you bought a home, especially if you bought it early in the year, you took advantage of all those equity gains throughout the year. Wow. 2021 was a great year. But what about 2022? That's where we're at now. We can look back at the past and be happy and be joyous, and especially if we did good in 2021, income wise, finances, we did great. The tax manna cometh. But what about 2022? What is going to happen in 2022? That is that's what we're going to look at now. But before we do, please visit my website, shopkentuckyhomes.com. And again, on that website, you can find your next home. You can get a valuation for your current home. You can get updated market reports. And you can communicate with your favorite realtor, hopefully your favorite realtor, David Hittle with United Real Estate Louisville. So visit shopkentuckyhomes.com today and just see what all you can do on that website. So, what to expect in the 2022 housing market. So, these are mortgage rate projections. So, for quarter one, the projected mortgage rate is 3.3%. Well, that's gone out the window. 3.3% has been beaten by 3.55%, which is what we were averaging last week. I don't think that those mortgage rates are going to go down. They very well may surprise me, but not. I don't believe that they're going to go down with all the talk coming from the Fed of interest rate hikes in March. I do not believe we're going to see 3.3 as the average for quarter one. Quarter two was predicted 3.45. Again, that's been beat. Quarter three was projected to be 3.55. Well, that's what we're sitting at now. And if the projection is that we're going to go up, then we're going to go up from 3.55. We're not going to see 3.30. It's already gone. It's been crushed. The overall projection for quarter four, which is the end of the year, was 3.7%. Again, I believe I'm predicting myself, I guess, that we are going to see between a 4 and a 5% in the market, in the retail market. So when you go to your lender and you ask them what the interest rate is, they're going to tell you between 4 and 5%, which is higher than we are now used to, but historically low. So that that covers that. So we were also talking last year about all the forbearances, and we were somewhat worried that we were going to see a flood of um, um, short sales and a flood of foreclosures hitting the market. Well, in actuality, forbearances are finally under 1 million. So at the peak of the coronavirus, May of 2020, held the record for forbearances with 4.76 million individuals, homeowners were in forbearance. And today we are at 890,000. So still a lot of individuals on forbearance, but a lot less than we saw at the peak of the coronavirus. The senior leader of research at CoreLogic, Mary Claire Bolton Smith, says that we may see a little bit of an uptick in foreclosure rates in 2022. Just an uptick, though, from an extraordinarily low level. And we are not expecting to see a big increase. We expect delinquency rates overall on home mortgages to actually continue to remain quite, quite low. So that is another good thing, but it's also a bad thing. It is a good thing that homeowners that are currently in forbearance are getting off forbearance and they're actually going to be able to keep their home, which is what was intended to begin with. The bad news is it's not going to add to our inventory, which is in dire need of additional inventory. So we're going to have to find that inventory from other sources, maybe new construction. But while supply chain issues continue to occur, and while the price of materials continues to rise, that might not be the spot we find it. So we turn to homeowners. Homeowners, are they wanting to move this year? Well, if interest rates are going up, then moving this year may not be a good idea. They may get a higher interest rate. But is their next home more important than the interest rate? Very well could be, and they could pay some points with the equity that they've built in their current home to pay down that interest rate as well. So there's always a way, always a way around. Has home price acceleration peaked? So as we know, if you've been listening to me for any period of time, home prices have gone way up. All of the projections right now is that it has peaked. So it was doing an airplane on takeoff, but now everything is starting to level out. And actually, some predictions are showing that it's going to start to come back the other way. So home prices will continue to increase. However, they're going to increase at a slower pace than they did in previous years. And I predict, just using my own thought logic here, that if mortgage interest rates continue to climb extraordinarily like they currently are, then I believe that home prices will have to come down in order to find those buyers that can afford the home. Home price forecast for 2022 is averaging 5.2%, so a lot lower than we have been used to. We have seen 20 to almost 30% increases in home prices, but the prediction now, the average of all 7 of the predictions here, is 5.2%. So the days of 20% um, home price appreciation may be over, and that's due to just the what goes up must eventually come back down. Home prices uh, are predicted to not decrease. They're not looking to decelerate, but they're just not going to accelerate at the same pace that they had. The market is going to slow a little bit. Again, Mary Claire Bolton says overall, she believes that 2022 will be another strong year for housing, albeit a little bit higher mortgage rate, and we're seeing that those interest rates are going up. And we do think that home sales will continue to rise and actually reach a 16-year high in 2022. So Core Logic is actually predicting a new high for real estate prices, 16-year high this year in prices. So we will see whether